Welcome to today's lecture. Good evening. In our previous lecture, we started with investment appraisal. This is a second part of investment appraisal where we are going to be concentrating much more on some techniques in appraising investments. So some basic knowledge is already assumed to have been had by students. So we just move on from where we left off our last lecture. We're going to consider the effect of inflation on cash flows. So when you are given an investment appraisal question, and within the question you are asked to, or you are given information that you are supposed to use to inflate certain figures, maybe revenues or costs and so on and so forth. How do you deal with them? And now, usually, inflation is something that is real when it comes to the business environment. Future cash flows are affected by inflation, and so the future values of cash flows will not be the same as the present value of cash flows. So, because of inflation, and we need to deal with inflation in most of our investment appraisal questions. Here we go. Let me pick a pointer. Okay. So in business environments with inflation, future cash flows will have decreasing purchasing power in current value terms. So as time goes on, the cash flows you have will not be able to sort of purchase goods and services as they would be in present terms. Now, if inflation is expected, for instance, to be 5% per year, and cash amount of 100 is received at the end of each year for 3 years, let's look at how the deflated values of these future cash flows receipts would look like. So what it means is that this 100 Ghana cedis is a current amount, and then if you have an expectation of 5% inflation, it means that the future value of the 100 cedis is going to be lower. Now let's see how that is going to be computed using the inflation figure to deflate the 100 Ghana cedis in future. So if this is what is being received according to the scenario, 100 Ghana cedis every year, year 1, year 2, year 3, you're receiving a constant amount of 100 cedis. What it means is that you need to calculate a deflation figure or a discount factor. We've talked about discount factor in our previous lecture, and we know how to calculate the discount factor. So deflation here also refers to as discounting. So we know how we arrived at this is 1 over 1 plus r to the power n, where n here is 1. That is for year 1. So that comes to 1 over 1.05, and that gives us a discount factor or a deflation factor of 0.952. You then multiply that by the cash flow that is going to be received in 1 year's time, and that gets you to 95.2. So clearly we can see that the future value, that is the 1 year value of the 100 cedis, is lower than 100 cedis. We apply the same principle to year 2 cash flow, year 3 cash flow, and then we see what the deflated values are. So in investment appraisals, these things are very real, and we are expected to apply our techniques to be able to appraise the investment appropriately. Now, the same way, the reverse is that if you are asked to inflate figures or cash flows from current values to future values, this is just going to be the reverse by just applying the inflation factor. So that is 1 plus r, 1 plus r, where r is the inflation figure of 5%. So 1 plus 5% gives you 1.05. Multiply that by your cash flow, and that will give you the cash flow for the next year, which is going to be higher. That is if you are inflating. Same is going to be applied to cash flow for year 2, cash flow for year 3. So in this case, year 2 is going to be 1 plus r to the power n. 1 plus r to the power n. So this is just the inverse of the other one. Here it is 1 plus r to the power n, where n is the number of years. Over here, the reverse is 1 over 1 plus r to the power n. Okay, so once we do that, we get a factor. We multiply by the cash to be received in 2 years' time, and that will bring us to what, 110. So this is how much would be received in 2 years' time. We apply the same for year 3 cash flows, and we get 115.76. So what it means is that if you should discount this figure with the same rate of 5%, it will bring you back to 100 Ghana cedis for year 1. If you deflate thus 110.25 with thus 1.05 using the formula 1 over 1.05 to the power 2, it will bring you back to 100 Ghana cedis, and so on and so forth. Now, usually there are 2 types of inflation figures you come across in a typical investment appraisal. It's not always the case though, but I mean, you are likely to have 2 kinds of inflation figures coming in. You have what we call the general inflation and specific inflation. Now, it is important we understand the differences between general inflation and specific inflation. General inflation usually is measured by published measure or published data. So you hear Ghana's inflation figure is somewhere around 40.7%. That is general. It affects generally goods and services. But there is what we call specific inflation, which affects specific cash flows, not all cash flows. General inflation will affect all cash flows. Specific inflation will affect just some specific cash flows or variables, like selling price. So selling price can be given you for, let's say, year 1, and then you'll be asked that, or you'll be told that selling price is going to increase or will be inflated by a certain percentage for the next 3 or 4 years. So year on year, you apply this inflation, this specific inflation to just the selling price. You may have a specific inflation for variable cost, fixed costs, and so on and so forth. So we'll take an example and see how that goes. So for instance, we have in this instance specific inflation for selling price of 5%, specific inflation for variable cost of 4%, and that of fixed cost is 6%. So for each of those cash flows, you are going to inflate them by these figures or by these percentages that have been given respectively. Now let's also understand the difference between real and nominal cost of capital. Cost of capital is very important when it comes to investment appraisal. It is that which we usually use to discount the cash flows. We use it to discount the cash flows. But it's important we understand the difference between real cost of capital and nominal cost of capital. Oftentimes, the question would give you information that would help you to calculate nominal cost of capital, or it will be given to you straight away so that you don't have the difficulty or you don't have the challenge of having to calculate it. And there is this formula we call the Fisher formula that links the general inflation with the real inflation to give you the nominal cost of capital. So the real cost of capital and the nominal cost of capital are related. So in the Fisher formula. So this is the Fisher formula, and it's often provided in the exam or on the exam sheet. But like I always say, I expect that you know this formula. This is not too difficult to keep in memory. The difficulty is that if you don't keep this in memory and you would have to rely on what the exam question provides for you, means you may probably have to flip pages, go to the end of the question paper and then pick this and then now come and write and use it. You are likely to even make mistakes sometimes in copying it, but if you have it in your head, it's easy to use it. You only refer when you probably have forgotten and you need to just get a reference. So thus, I is the nominal cost of capital. R is the real cost of capital, and H is the inflation, as the general inflation, which we spoke about already. So general inflation, 1 plus general inflation multiplied by 1 plus real inflation gives you 1 plus the nominal cost of capital. Now, so let's see how this works out, given a very simple example. If the real cost of capital is 4% and general rate of inflation is 4.8%, what would be the nominal cost of capital? So you simply have to pick this Fisher formula and then insert your various inflation figures. So here we have real cost of capital, which is the R, 1 plus R, multiplied by 1 plus general inflation, which is 4.8, is 0.048 added to the 1, and then you equate it to your nominal cost of capital. Then you compute it and then you arrive at 9.0%. So thus 9.0% nominal cost of capital is what would be used to appraise the investment or as your discount factor. So let's watch this, very important. Since cost of capital are normally given in nominal terms, so for most exam questions, you see cost of capital given to you in nominal terms. But in a few questions or at times, you may see questions that would give you the real cost of capital and give you also the general inflation, and then you are expected to kind of work out what the nominal cost of capital is going to be applied to the investment appraisal. And for such questions, usually you would have some specific inflation for maybe revenue, variable cost, fixed cost, and so on and so forth. So since cost of capital are normally given in nominal terms, it is more usual to calculate the real cost of capital by deflating the nominal cost of capital by the general rate of inflation. So for questions that would require you to use the real cost of capital, you would have been given the nominal cost of capital and the general inflation figure. And then you only have to do a change of subject, make 1 plus R the subject of the equation by dividing both sides by 1 plus H. So when you divide this side by 1 plus H, that side by 1 plus H, you're going to have here 1 plus H divided by 1 plus H cancelling out. You'll be left with 1 plus R here, and that will be equal to 1 plus I over 1 plus H. Then you do your computation on the side, and then you make R the subject of the equation by taking 1 to the other side to be deducted. So I'm sure we know this. So you arrive at 4% if you are given this information. This should be quick, easy to understand. Let's consider what nominal cash flows are. Nominal cash flows are current price terms. So when you are giving prices in current terms, they are referred to as what? Nominal cash flows. But then they would have to be inflated by the specific inflation figures, right? So nominal cash flows are current price terms cash flows that have been inflated into future values. So as we saw previously, for each of those cash flows, you're going to have their specific inflation figures that we use to inflate them and then you arrive at what we call the nominal cash flows. That is the future cash flows, using either general or specific inflation. If you have general inflation, that makes it easier. But then if you have specific inflation, then for each cash flow, you have to multiply by a specific cash flow. Example, forecast sales volume is 300,000 units per year, increasing by 50,000 units per year. And then the investment project is expected to last for 4 years. Required. What are the sales revenue and variable cost? So here we are given sales volume, and which was 300,000, and we are told that it's going to increase by 50,000 per year for the next 4 years. So for year 1, you're going to have 300,000. The next year, you're going to have to increase it by 50,000, the following year by 50,000, and so on and so forth. Now, we're also giving selling price. Remember, this is unit volume, or the volumes that are going to be sold, and thus is your selling price per unit, given as 5 cedis, 30 pesos. So if you wanted to calculate the revenue, it's simply going to be what? Your unit price multiplied by your volume or sales volume for that particular year. Variable cost, remember this is variable, so it will vary according to the volume. So if you are given a variable price of 3.15 per unit, then the total variable cost is going to be 3.15 multiplied by 300,000 cedis for that year. And you're also told or given further information that selling price inflation, so this is specific inflation for selling price, is 5% per year. Variable cost inflation is 4% per year. It means that if your current selling price, which is given as 5.3, then the next year your selling price is going to increase by this 5%. So you multiply your 5% by 5.3%, and that gives you the selling price per unit for year 1 or the next year. And then you keep inflating with the 5% like that. And you also multiply by the respective volumes, which we have talked about already, to have been increasing by 50,000 cedis per year. You apply the same principle to your variable cost inflation or variable cost, which is inflated at 4% per annum. Let's see how this is done in real time. So nominal cash flows, we're told that nominal cash flows are cash flows, current cash flows that have been inflated to future values. It could be specific inflation or general inflation. Now, from the example we are seeing, this is specific inflation. Now, for year 1, we are looking at selling prices. And remember, selling price inflation is 5%. So 1 plus 5% gives you 1.05%. You multiply by your current selling price per unit of 5.3, and that gives you 5.57 per year, or sorry, per unit for year 1. You do same for year 2 by multiplying by 1.05, or you stick to the original 5.3, and then you multiply by 1.05 to the power 2. So either you pick this 5.57 and then multiply by 1.05, it will give you the same result as 5.84. Or you pick the original 5.3, you multiply it by 1.05 to the power 2, because this is for year 2. So any of them that is easy for you, you can choose it. For year 3, it's going to be what? Times 1.05 to the power 3. Or you pick that of year 2 and you simply multiply it by 1.05. And that gives you 6.14. For year 4, you multiply by 1.05, it will give you 6.44. Or you pick the original 5.30, you multiply by 1.05 to the power 4, because this is for year 4. So we apply the same principle for sales revenue. So we apply the same principle for variable cost. Now that we have our inflated selling prices. We've calculated them for each of the years 1, 2, 3, and 4. We can now multiply the selling prices by the volumes, the sales volumes that we determined earlier to have been increasing by 50,000 per year from 300,000. So you pick for year 1, what you had was 5.57. You multiply by your 300,000 for year 1. Year 2 would be 350,000 multiplied by year 2's what? Selling price per unit. You do the same for year 3 and year 4. And you arrive at the nominal cash flows or the future cash flows. Like I said, you apply the same principle to the variable costs. Variable costs is given as 3.15 from the question. 3.15. We expected to inflate it by 4% per annum, which is 0.04. So using the same formula, the inflation, your variable cost multiplied by 1 plus 4%. That gives you inflated variable cost for year 1, multiplied by 1.04, sorry, to give you the inflated variable cost for year 2. You do the same for year 3 and year 4. You get the cash flows for the variable cost. And remember, these are only the inflated variable cost per unit. Per unit. So if you wanted the total variable cost, you would have to multiply by the number of units for each year. So for year 1, it's 300,000. So you multiply that by 3.28. Year 2 is 350,000. Multiply that by 3.41. You do the same for year 3 and then year 4. Okay. That's good. So we have seen what nominal cash flows are. We've seen examples. And hopefully by the end of this lecture, there will be a full question that will bring into play nominal cash flows, real cash flows, and so on and so forth. Okay, let's look at real cash flows. Real cash flows are found by deflating nominal cash flows by the general rate of inflation. Remember, we saw an example where we're given nominal cash flows and or nominal cost of capital, and we're to determine the real cost of capital. And we had to use the Fisher formula and made real inflation the subject of the equation. And we arrived at the real inflation by actually deflating the nominal cash flows that we had. Okay, so here we are going to look at real cash flow, not real cost of capital. We are looking at cash flows, and basically it's going to be similar principle. So let's take this example. Example of calculating real cash flows by deflating nominal cash flows. Using the nominal cash flows calculated above and a general rate of inflation of 4.8%. So I think there are some data that is missing here. We're giving data on total contribution for years 1, 2, 3, and 4. We could calculate it using the information we have. That is our revenue less our variable cost. I'm sure we remember that revenue less variable cost will give you contribution. So if you did that, so I'd like you to do that assignment. Complete the revenues for each year, and then complete the variable cost for each year, and then deduct that from the sales revenue. It should give you the contributions for the various years. And this is what you are supposed to get for year 1, year 2, year 3, and year 4. And in this question, we are asked to calculate the real cash flows, So what you would get after this simple assignment of taking the variable cost from the sales revenue is going to give you your contribution, which is nominal contribution. Now, this question is asking us to calculate the real or contribution in real terms. And we only have to what? Deflate it. For each year, we're going to deflate by 4.8%, which has been given as the general rate of inflation. So we use that to deflate. We've seen deflation in our previous discussion. So thus, which is your nominal contribution for year one, you deflate it. That is, you reduce it or discount it by your general inflation rate. And that will bring you 2655,534. You apply the same for year two. This is going to be squared. This is going to be squared. For year three, is going to be to the power 3. Year 4 is going to be to the power 4. And then you get your deflated figures. Okay, let's talk a bit more about inflation. The money method for inflation is where inflation is included in both the cash flow forecast and the discount rate used, while the real method is where inflation is ignored in both the cash flow forecast and the discount rate. So basically, you are given an investment appraisal question where you are asked to use the money method. The money method means that you're going to inflate both the cash flows and the discount rate. You're going to do that to both the cash flows, the individual cash flows, and the discount rate that you're going to use to discount your cash flows. And for the real method, you just leave the figures as they are. You're not going to inflate. You're not going to inflate the cash flows. Neither are you going to inflate the discount rate. So let's get the difference. The money method and the real method. So questions will be specific on what you should use, or sometimes the information that is given you will determine what you should use. The examiner can be silent, provide you with the necessary information, and then you would have to know which to use depending on what information has been given you. Now, the money method should be used as soon as a question has cash flows inflating at different rates. So thus it's a clue. When would you use money method? You use money method when the cash flows are inflating at different rates, as we saw before. Variable cost is inflating at its own rate. Revenue or selling price per unit is also inflating at its own. Once you see that, it should give you a clue that we are going to use the money method. Or where a question involves both tax and inflation. If you have a question that has both tax and inflation, then you are likely to use the money method. Because of this, the money method is commonly required. Like I said previously, a lot of these investment appraisal questions are based on the money method. All right. I also use the Fisher formula to calculate a money cost of capital, or indeed a real cost of capital for discounting purposes. So let's remember the Fisher formula. 1 plus I is equal to 1 plus R into brackets multiplied by 1 plus H. Okay, that's the Fisher formula. Use the Fisher formula to calculate a money cost of capital, which is your I. 1 plus I. So you eventually have your I. I becomes your money cost of capital. Or indeed, a real cost of capital for discounting purposes. Remember, the cost of capital, the purpose of calculating the cost of capital is to discount our cash flows. They must also be able to distinguish between a general inflation rate, which will impact on the money cost of capital, and potentially some cash flows, and a specific inflation rate, which only applies to particular cash flows. We've seen this already. Now let's talk about the impact of taxation. So this is one of the techniques we would have to apply in our investment appraisal questions. When you are given taxation or information on taxation, you need to incorporate that into your investment appraisal. Remember, taxation is cash flow. You have to pay tax, you pay in cash. So that is cash flow. and it's relevant to the investments that you are doing. Remember the definition for cash flows, what a cash flow is, or what a relevant cost is. In investment appraisal, we are only dealing with what relevant cash flows, and taxation is a relevant cash flow. Now, building taxation into a discounted cash flow answer involves dealing with the good, the bad, and the ugly. Let's see what the good is. The good news is that with taxation, there is tax relief. Remember that there is always tax relief. Once you pay, you make certain payments, there is tax relief, or you are told that there is some capital allowances to enjoy. So the good news is that taxation, there is tax relief. This is, once it's a tax relief, it means it's a what? It's a cash inflow to the business or to the organization or to the investment. It's often granted on the investment in assets, which leads to tax-saving cash flows. We'll come and see, or we'll come to see about those capital allowances. The bad news is that where a project makes net revenue cash inflows, the tax authorities would want to take a share of them by way of what? Paying tax on the project. The ugly issue is the timing of these cash flows. So at times, the timing of the cash flows is very critical. So first of all, you're expected to calculate what the cash flows are, but the timing is also very important. Sometimes taxes are paid, we are told that taxes are paid in arrears. It means that if a tax arises in a year of calculation, or in the year it arises, you will not pay the tax that year, but you pay it in the following year. So it means the timing of the cash flow is not that particular year, but the next year. So the timing is quite important. Let's pay attention to that. There's also something we have to deal with called working capital. Oftentimes, once you start your investment with some monies to, or some funds to buy equipment or initial investments, you would also need to invest in working capital to buy your inventories that will be turned into products for sale that will give you the necessary cash inflows. So working capital is something we have to also deal with, which we didn't talk about in our previous lecture. An increase in working capital is a cash flow. But is it cash inflow or a cash outflow? It's a cash flow, we all agree. But the question is, if you increase your working capital, what happens? Is it a cash inflow or a cash outflow? Obviously, it's a cash outflow because you are increasing the cash requirement for the work you are doing. If a company needs to buy more inventories, for example, there will be a cash cost, which is going to be a cash outflow. A decrease in working capital is a cash inflow. So you see the clue here. If you are decreasing working capital, it is cash inflow. If you are increasing working capital, it is cash outflow. Hence, at the end of a project, when the working capital invested in that project is no longer required, the cash inflow will arise. So once you put in cash in the form of working capital, at the end of the investment appraisal, say 4 years or 5 years, the cash that was injected in the form of working capital would come back as what? Cash inflow. That's what this is seeking to say. So anytime you put in working capital, you put in 1,000 at the end of the investment appraisal, that is the last year, it will come out as what? Cash inflow to the project, because it is no longer needed, because the project has come to an end. So it becomes a cash inflow to the project. It is the change in working capital that is the cash flow. So remember, once you start with a specific working capital, say in year 0, you started with 100,000 Ghana cedis as your working capital. The change in working capital is 100,000 because initially it is 0. right? And then you introduce 100,000 as working capital. So the difference or the incremental working capital is from 0 to 100. So the difference is what? 100,000. If you have to increase working capital the following year from 100 to 150, 100,000 to 150,000, the cash flow or the working capital requirement is not going to be 150. It's going to be what? The incremental from 100 to 150. So that becomes what? 50. Let's take note of this. The cash flow for year 2 will now be 50 because the 100 is already there. You're only increasing your working capital requirements to 150. So you only introduce what? 50. So that becomes the cash flow for year 2 and not 150,000. It's important. If you get to year 3 and you have to reduce working capital from 150 to say 80,000, the difference in cash flow is from 150 to 80. You are decreasing cash flow. This becomes cash inflow, the working capital, because you are reducing the requirement for working capital from 150 to 80. So the difference from 150 to 80 is 70. So that becomes the cash flow in respect of working capital for year 3. I hope that is clear. All right, so it's always the incremental or the change in working capital. That is what is the cash flow for that particular year. We know about relevant cash flows. And let me mention again that in investment appraisal, we are interested in relevant cash flows. Anything that is not relevant cash flow, you ignore it. Something like depreciation, amortization, and so on and so forth. They are not cash flow, so we are not interested in them. Sunk cost is also not relevant to this investment appraisal. We know the criteria for determining what a relevant cash flow is, and we know that for a sunk cost, there's a cost that has been committed or paid already, and so whether the investment comes on or goes ahead or not, that has been paid already. There's no way you're going to get that money back, so it's not a relevant cash flow. Now, to be included in a cash flow table, an item must be a future, so it must be a future incremental cash flow. There must be something subject to the decision that is being made in future. It must be incremental, just as we saw, and it must be what? A cash flow, not depreciation, not amortization, not any other thing that is not cash flow. Irrelevant items to look out for are sunk costs, such as amounts already spent on research and apportioned or allocated fixed costs. When amount is allocated, it is not a cash flow, unless there is an incremental difference or a change in that cash flow. That is fixed cost. If fixed cost is increased, if fixed cost increases from one level to another, that difference becomes a cash flow. But if it is just allocated, then that is not a cash flow. Equally, all financing costs should be ignored, as the cost of financing is accounted for in the discounted or discount rate used. So remember, if you are told in a question that there's a finance cost of so and so, don't consider that as part of the cash flow, because that would have been taken care of or would be taken care of when you are doing your discounting. To be taken care of. So don't include financing costs in your cash flows. Fixed appraisal horizon. Sometimes directors of a company will only appraise projects across a set time horizon, which will not be the full length of the project, and so does not include all of the cash flows. If a 4-year time horizon is used, then the tax effect of the 4th year must be taken into account, even if tax is paid in arrears, and the cash flows arise in the 5th year. So let's not forget, if the cash flow is arising in the 5th year, that is outside the 4 years, assuming 4 years is when the project is being appraised. Let's remember to also include the tax to be paid in the 5th year. Having reminded you of the potential problem areas, now let's consider a comprehensive example. So that's an example that embodies a lot of the things we have discussed. I would like you to apply what we have discussed so far to this question. Do it as best as you can. And when we meet in class, we would work it out together. But take this as a trial question. And then when we meet in class, we'll discuss this fully. Thank you so much for your attention. See you. Bye-bye.